What do corn, soybean, and wheat futures reveal about farmland value? Imagine standing in a vast field, watching the seasons change, and wondering what the future holds for your land's worth. Futures markets for crops like corn, soybeans, and wheat are like weather forecasts for farmland value. These contracts are traded on exchanges such as the Chicago Mercantile Exchange and set prices for crops to be delivered months ahead. When futures prices for these crops go up, it signals that traders expect higher prices for the crops in the future. That usually means farmers could earn more from their land, making farmland more appealing to investors. For example, if the futures price for corn rises by 10%, farmland values in regions like the Midwest tend to increase by about 2%. But it's not always a straight line. Sometimes, investors see high futures prices as temporary and don't change their land valuations much. Other times, they might expect prices to stay high and bid up land prices accordingly. So, the link between futures and land value is real but not perfect. Several factors can influence this connection. Low interest rates make borrowing money cheaper, which can push up farmland prices even if crop futures stay steady. Rising costs for fertilizer, fuel, and labor can cut into farm profits, limiting how much land values can increase even if crop prices look promising. Large harvests can also lower crop prices unexpectedly, even if futures markets suggested higher prices earlier. For instance, a bumper corn crop in 2025 might cause prices to fall, which could slow or stop farmland value growth. Investor sentiment plays a role too. When other investments like stocks or bonds seem risky, farmland can be seen as a safe haven, supporting prices even if futures are not showing strong signals. For farmland investors, keeping an eye on crop futures is helpful, but it shouldn't be the only tool. Regularly check futures prices to gauge market expectations. Compare these with actual supply reports, crop yields, and weather forecasts. Watching interest rate trends is also important because they affect how easily investors can finance land purchases. Remember that the relationship between futures and land values is strongest in areas where these crops dominate. In other regions, different crops or local factors might be more influential. It's also important to recognize that futures prices are just expectations. Unexpected weather events, trade policies, or global economic shifts can change the game quickly. Land prices tend to move more slowly than futures because farmland is a long-term asset, and local conditions like soil quality and location matter a lot. To sum up, crop futures are a key indicator for farmland value, but they are just one piece of a bigger puzzle. Combining futures data with interest rates, production costs, and regional factors helps investors make smarter decisions. By understanding these relationships, you can better anticipate how farmland values might change in the months and years ahead.